Hey everyone, hopefully you're having a good day. My name's Andy. My channel's Finding Value. Today we're going to go through Twitter, see what people are sharing on social media. I'll interject my financial opinions as we go through it, generally related to three different topics: wealth building, commodities, and/or financial topics. Let's dive right in, take a look, see what's going on today. If you want to follow me, it's at @Finance. And if you want to join our community, finding-value.com, where I dive deeper into all these topics and subjects, looking for investment opportunities, sharing those opportunities with everybody in the community. I did just release a midweek update for everyone in the community, sharing my opinions on individual companies and what I'm doing. And if that sounded interesting to you, special is a coupon code, 50% off the first month only on a monthly membership, and a larger discount on the yearly membership if you'd like to sign up. All right, so diving in. Sam Altman just admitted AI is similar to the dot-com bubble that caused the NASDAQ to collapse 80%. Now, why would he admit it at this precise moment in time? I bet you can guess. It says, when bubbles happen, smart people get overexcited about the kernel of truth. Are we in a phase where investors as a whole are overexcited about AI? My opinion is yes. Is AI the most important thing to happen in a very long time? My opinion is also yes. Altman appeared to compare this dynamic to the infamous dot-com bubble, a stock market crash centered on internet-based companies that led to massive investor enthusiasm during the late 1990s. Between March 2000 and October 2002, the NASDAQ lost nearly 80% of its value after many of these companies failed to generate revenue or profit. So, yeah, I do think that we are in a similar situation to the dot-com bubble. I think that valuations are stretched. I'm not sure how AI is going to translate all this spending and investment into dollars. What what they were measuring back in the dot-com bubble were eyeballs. How many eyeballs could they attract to whatever they were selling or doing? And I feel like that's kind of similar to today. It's a little bit different, but it seems to rhyme enough where I'm not exactly sure how they're going to massively profit from it, and increase earnings and all that stuff. That's his opinion. Wanted to share it. Thought it was interesting. Japanese yields on the 10-year. So notice the pattern. Notice when this pattern, and let me open it up here. So this is the Japanese 10-year. I'm going to zoom in so you guys can see the pattern a little bit bigger. So this bottom here was July of 2016. So 2016. And this one here was the bottom of basically 2019 was the bottom. So yields bottomed in 2016, 2019, and this is what the chart pattern looks like for Japanese 10-year yields. Now, check this out. If I scroll down, that's COPX, the copper ETF. Do you notice anything similar to these two charts? Anything similar? You see anything similar? Right, it's the same pattern. How could that be? We come on up a lot more in yields here, and then copper's been consolidating here a little bit more on this breakup here. So yields moving up and commodities basically showing the same exact chart pattern. And it's not just COPX. I mean, I can go into a whole bunch. Here's COPX. So there's COPX that I was doing. SLX, which is VanEck Steel ETF. Same pattern. You can do URA, and it's roughly the same pattern. So here it is. Let me blow it out there. So it's this and this. You can see it's a little bit different. It pulled back into a big slingshot here, and then it slingshotted up. That's my slingshot cheetah I always talk about. But your double bottom is these two humps there. And then we did a slingshot higher. We consolidated just like COPX, just like SLX. There's other ones too. Moo's a little bit different. I'm not going to go over Moo. But there's a lot that has this pattern here. We can even see these patterns in individual single equity companies. So I wanted to just show you that. I wanted to show you, look, there's patterns that are very similar in yields and in COPX in a lot of the commodities. Now here's something. You guys have seen this before. Here's the US 10-year Treasury bond yield. It's a little bit busy here. Let me put this on here. Okay, so we've got, that's a shoulder head shoulder topping pattern there, and another shoulder head shoulder. But down, up, down in yields. You know what else follows that? Silver does. So here's silver. And then you can see, I'll make it a little bit more obvious here. So there's silver going on up. Here's your cup and handle pattern of, here's the cup, there's the handle. And guess where that was created? In the declining interest rate environment. So uptrend, sideways consolidation, downtrend, consolidation. There's another cup and handle. If you guys look here, cup and a handle. Do you guys see anything? Do you notice anything? Anything similar? Anything similar here? And then what happened recently? Interest rates broke out. So in staying true to the long-term investing in me, we're in a bull market. We're in a bull market for silver. The reason I'm showing silver and not gold is silver was freely traded back here. Gold was still on a gold standard and it was held down. So that's the reason I'm not showing this particular area or showing gold for that particular area, because it didn't go anywhere. It was on a fixed pricing. So silver is freely traded. There we go. We're coming into an increasing interest rate environment on the long term. Doesn't mean that we can't have a short-term pullback. I'm not saying anything of that sort. Do not confuse that with me saying it can't go lower. I'm just saying that we're going to have higher highs and higher lows in an uptrend. And that I think that gold and silver are going to be in uptrends for a very long time until this dynamic changes. And I can't tell you when that's going to change. I don't see how it's going to in the short term. Now, in the short term, could we get a slowdown in the market and could yields relax a little bit? Oh, for sure. For sure. I'm not saying it can't go down. I'm just saying longer, bigger picture view. This could be a pretty long haul for gold and silver and yields to go higher. Coming back. And this is what sparked it. Japan's 20-year bond yield just surged to 2.61%. Why? A brutal government auction just shook the market. Here's what happened, why it spooked investors, and why it could ripple far beyond Japan. And that's the double bottom I was looking at. I was like, you know what? I want to put that mark on there. We can go through this real quick. Japan just tried to auction off a batch of 20-year government bonds, long-term IOUs that promised to pay investors interest for lending money to the government, but demand was weak. The result? Yields surged in the bond world. Spiking yields equals panic mode. So to be clear, a bond yield is the interest the government pays to borrow money. When few investors show up at an auction, the government has to offer higher yields to convince them to buy. That's exactly what just happened. The yield hit 2.61%, and that's what's going on here on the right-hand side. You see the yields are just rocketing higher. It's the unwillingness for people to buy Japanese bonds at that duration. This wasn't a failed auction, but it was far from pretty. The bid to cover ratio, a key gauge of demand, dropped to 3.09, meaning investors submitted 3.09 yen in bids for every 1 yen of bonds offered. That's down from 3.15 at the previous 20-year auction and below a 12-month average of 3.24. So what changed? Politics. Japan's ruling coalition lost its upper house majority for the first time in over a decade. Why does that matter? Because political instability equals more spending uncertainty, more debt risk, and potentially snap elections. Markets hate that. But there's a deeper concern. The Bank of Japan is stepping back for years. The BOJ was the buyer of last resort, scooping up bonds to cap yields. This policy was called yield curve control. Now that safety net is being pulled away. With the BOJ slowing its bond purchases, real demand needs to show up, and it's not. Investors don't want to lock up their money for 20-year Japanese bonds when inflation is rising, debt is growing, and the central bank may not step in to save them. And this is happening to America too, guys. So let's talk debt. The Japanese debt to GDP ratio is over 260%, the highest in the developed world. Rising yields means that it becomes even more expensive for the government to service its debt. It's a vicious cycle. More interest payments equals more borrowing, which equals more risk. In response, Japan's Ministry of Finance tried to cool things down. They announced they'll cut issuance of 20 and 30-year bonds by 100 billion in October, December. But markets were not impressed. Yields stayed high. The message was clear. It's not enough. Why does this matter outside Japan? Because Japanese investors are massive global bondholders. They own huge slices of the US treasuries, European debt, and more. If yields rise at home, they may pull money out of foreign bonds to chase higher returns in Japan. That shift would be global. If Japan sells US treasuries, US yields rise. If Japan ditches European debt, Eurozone yields rise. This bond auction wasn't just a Japanese problem. It risks shaking global bond markets, including the United States. There's another ripple. The yen. If Japanese bond yields rise, the yen could strengthen, drawing capital home. And that's with the strength of yields behind the monetary policy. But a stronger yen hurts exports. So if Japan fights back by weakening the yen, it risks inflation. It's a tug of war between stability and competitiveness is brewing. And here's the trap. If auctions keep flopping, the BOJ may have to restart large-scale bond buying. But that risks stoking inflation and weakening credibility. They're stuck. Either tighten or hurt growth, or ease and risk losing control. If you zoom out, this isn't an isolated event. Japan's bond market has shown cracks for months. Volatile auctions, rising spreads, poor demand. What was once the most stable bond market in the world is starting to wobble. That's historic. The world has watched Japan for years as proof that a country can borrow endlessly with no consequences. But even if Japan is struggling to sell bonds without help from its central bank, what does that say about the rest of us? This 20-year auction might be a turning point, not just because yields hit 2.61%, but because Japan's debt model is flashing red. If bond vigilantes are waking up in Tokyo, DC should be on edge. All eyes are on the US 20-year bond auction this Wednesday. And that's what's going on with yields and bonds with Japan's market. And that could be the beginning of higher yields. Could be. We've got bullish oil bets are at 16-year lows. And remember, some of these, when they were really high, were tops. Some that were really lows were bottoms. Like 2020 here. That was a heck of a bottom there. That big bottom. Coming down, novelism. The most common bad advice I hear is you're too young. Most of history was built by young people. They just got credit when they were older. The only way to truly learn something is by doing it. Yes, listen to guidance, but don't wait. Here's one. A lot of people talking about hydrograph. A lot of people have brought that up during the Q&A session. They wanted my opinion on hydrograph. Calvin says no position, but it has been insane to watch this play out. It's like a crime thriller. So, what are my opinions on Hydrograph? Well, um, Hydrograph is a graphene company. They have a different process to produce graphene. It apparently meets some sort of strict quality rules and guidelines, and that was a big problem with graphene in history was the quality of the graphene that was produced. I do not know what the break-even costs are to do that. I don't know how scalable it is. I'm not exactly sure how good their pieces are, even. So with Hydrograph and yeah, when I look at the chart, it's gone vertical. Here's Hydrograph clean power. Decides to come up, I'm going to do this. So there's Hydrograph at the top. There's the candlesticks. Big, big move, and then big selling pressure. So there it is. We had a big, gigantic move. Everyone piling into it. I saw Kevin was doing like a tweet every hour on it or something like that. I tend to avoid these guys. I tend to avoid them. I just don't get involved. I don't know enough about Hydrograph to give you guys any advantage. I am not sure if what they have created is in fact of the quality that is needed for applications. I do not know if their process is as good as they say it is. I don't know if it's scalable. I don't know how cheap it is. I don't know if it can compete with the alternatives out there in terms of other or graphene companies, and to compete with what is currently being produced, like copper, silver, and a whole bunch of other things that it would compete against. So my best course of action is to say, you know what, I don't know. I don't know if what they have is the special sauce that solves the graphene problem. So I don't get involved. So when someone asks me, what would I do with Hydrograph? I'd say I'm just not involved. I don't want to get involved. If I were to get involved in something, I'd want it to be before the breakout. So if this is the squeeze here, I'd rather try to get in when it's squeezing up than after, where you've got this gigantic move. Your risk goes up as this goes up. So it's getting riskier and riskier and riskier and riskier. And then eventually you could see a substantial pullback with the amount of speculative people in this and the amount of retail. So I don't chase this stuff, guys. I let it go and just say, you know what? I missed the entry and there's too much risk. I'm not gonna play with it. Now, would I have played with it? Probably not. Even if it was down here, I probably still would have not purchased it, only because I don't know how that's going to turn out. I think that the odds are against them, not with them, in terms of them being successful and having this graphene work. So I just don't play the camp because I don't know enough about the graphene space. So I don't play in it. Charlie Munger says, what could possibly be more useful in life than that? So he says, I did recently reverse the conclusion of two sets of engineers. How did I have enough confidence in such a complicated field to do that? Well, you might think, oh, this guy is just an egomaniac who's made some money and thinks he knows everything. Well, I may be an egomaniac, but I don't think I know everything. But I saw huge reasons in the circumstances for bias in each set of engineers as each recommended a course of action very advantageous to itself. And what each was saying was so consonant with a natural bias that it made me distrust it. Also, perhaps I knew enough engineering to know that what they were saying didn't make sense. Finally, I found a third engineer who recommended a solution. I approved. And thereafter, the second engineer came to me and said, Charlie, why didn't I think of that? Which is, to his credit, It was much better solution, both safer and cheaper. You must have the confidence to override people with more credentials than you, whose cognition is impaired by incentive caused bias or some similar psychological force that is obviously present. But there are also cases where you have to recognize that you have no wisdom to add, that your best course is to trust some expert. In effect, you have got to know and what you don't know. What could possibly be more useful in life than that? And I'm just referring this to hydrograph and graphene and some of these other things. Like, I look at this and some people say, what's your opinion? My opinion is I don't have one. I don't know if they have the special sauce. My guess is they don't. So I'm kind of going through this saying, I listen to some of the interviews and I'm like, I've been burned with a lot of companies. I don't fall for that stuff anymore, guys. Like if something's being pushed really hard to retail, say on Twitter, I just don't, I avoid it. I just don't get involved. I don't get involved. Think you're bad at timing the market. So are CEOs. And this is CEO business confidence expectations for the economy 6 months ahead. It bottomed basically with just overall sentiment every time when you should have been bullish in those time frames. Those are when you want to purchase 91, 0203, 09, 2020, and 2022 is down there. That is when you want to be bullish, not bearish. And those are the bottoms. Look at the bottom of every single one. So 6 months out, it would have been fantastic to buy every single one of these pullbacks. This is Howard Marks. He predicted the dot-com bubble in 2000, the Great Recession in 2008, the COVID crash in 2020, and here's his warning for families in 2025. Howard Marks is a billionaire co-founder Oak Tree Capital. He's sounding an alarm on three major recession signals. Over concentration. The Magnificent Seven tech stocks make up 32% of the S&P 500. That's double what it was 5 years ago. This is what's called elevated concentration, and it's exactly what we saw with the dot-com bubble. Credit market risks. Wall Street is lending at historically narrow rates. This signals overconfidence and props up companies that wouldn't survive if rates were worse. We saw the same thing happen in 2008. Inflation and policy. Between global inflation and trade tariffs, the Fed is left with a hard choice. Keep rates high to fight inflation or cut rates to prevent a recession. Mark claims this dilemma will trigger a recession sooner than otherwise. All that to say a recession could be coming, and if Mark is right, the cost of living will rise, layoffs will wipe out safe careers, and unprepared families will be in a serious danger. But while most Americans panic, smart families will have emergency funds ready, buy quality assets at a discount, come out ahead from an inevitable rebound. This is a major opportunity if you use it correctly. Mark would know he's made billions. Yeah, I'm not going to go through all this. So Howard Marks is basically putting on the table like, hey, look, there's some evidence here that we could enter a bear market recession here coming soon. And I agree. I think they're there too. I'm not saying there aren't. The Fed's in a difficult spot. Completely agree with that. Between inflation and unemployment. And I don't know what they're going to favor. If I were to guess, they're going to be as hard as long as they can. So they'll keep rates as hard as they can until the data changes. And then they'll just chase and react to the market. AI Data Center 101. For the next decade, natural gas and coal will be the primary sources of 24/7 power needed by AI data centers. ELNQ charts on fossil fuels are the key for short term, i.e., the next decade. So, nat gas and coal are going to be the primary sources of energy, electricity, power generation for AI data centers the next decade. So here's the best quotes of Peter Lynch. There's 25 of them. We've gone 24 minutes in here, 25 minutes. So yeah, we'll go through them. So know what you own and know why you own it. Don't be chasing price here. Know why you own everything. Everyone has the brain power to make money in stocks. Not everyone has the stomach, the volatility, the losses that you see, the stomach. The real key to making money in stocks is not to get scared out of them. You should not buy a stock because it's cheap, but because you know a lot about it. If you spend more than 13 minutes analyzing economic and market forecasts, you've wasted 10 minutes. Charts are great for predicting the past. You get recessions. You have stock market declines. If you don't understand that's going to happen, then you're not ready. You won't do well in the markets. People who succeed in the stock market are also accept periodic losses, setbacks, and unexpected occurrences. Go for a business that an idiot can run, because sooner or later, any idiot probably is going to be running it. Remember, things are never clear until it's too late. Uncertainty is what he's going for there. When you sell in desperation, you always sell cheap. Big companies have small moves. Small companies have big moves. Find something you enjoy doing and give it everything you've got, and the money will take care of itself. This is one of the keys to successful investing. Focus on the companies, not on the stocks. The trick is to not is not to learn to trust your gut feelings, but rather to discipline yourself to ignore them. Stand by your stocks as long as the fundamental story of the company hasn't changed. Invest in what you know. Hey, that sounds familiar. Hydrograph and myself, yeah, I'm not touching it. There's a no shame in losing money on a stock. Everybody does it. What is shameful is to hold on to a stock, or worse, to buy more of it when the fundamentals are deteriorating. The typical big winner in the Lynch portfolio, I continue to pick my shares of losers too, generally takes 3 to 10 years or more to play out. You guys understand that? He gets in a position and it generally takes between 3 to 10 years or more to play out. Gentlemen who prefer bonds don't know what they are missing. Never invest in a company without understanding its finances. The biggest losses in stocks come from companies with poor balance sheets. If you can't find any companies that you think are attractive, put your money in the bank until you discover some. Stocks are a safe bet, but only if you stay invested long enough to ride out the corrections. The person that turns over the most rocks wins the game. And that's always been my philosophy. And that's basically just digging into the data, the presentations, and trying to figure out what that company has to offer. When stocks are attractive, you buy them. Sure, they can go lower. I've bought stocks at 12 that went to 2, but then they later went to 30. You just don't know when you can find the bottom. All the math you need in the stock market, you get in the 4th grade. And that was the last one there for Peter Lynch's quotes. How to not lose money in the stock market. Wait longer. As time horizons grow, equity losses fall off. One day, 46% chance of negative returns. 1 month, 38%. And as you increase your holding period, the lowest being 10 years, which is only a 6% chance that you will have a loss. The only real test of intelligence is if you get what you want out of life. And that is actually a very good quote. I mean, that is really, really good. The only real test of intelligence is if you get what you want out of life. Yeah. Sven says, Bessent, gaslighting again. To be able to pay down the debt, you need to run a surplus to begin with. And none of the tariffs are large enough to do that. Not even close. And the spending bill just passed is running even higher deficits. So Bessent says, we'll use tariff revenue to pay down U.S. debt, bring down deficit to GDP, but they are not running surpluses. They're still running deficits. So that is not exactly true. So beautiful. First ever recorded net short position held by speculators in WTI, crude oil. So it looks like we've got our first record, or I should say recorded net short position there. So there it is. Are people bearish on oil? Oh God, yes. This is probably very close to a bottom. Patrick Karam says, have you ever wondered why crude oil and silver have been moving in sync since 1861? An invisible hand or a hidden law of markets? No, it's they go up under the same market conditions. And if you look, those market conditions are interest rates. That's what I found for the most part. When it goes sideways, and yes, you can still go up in a consolidation. This year is one big consolidation from 82 to where we are at today. And I know we had a big move in 2000s. That was the conventional oil getting all tightened up. But with the rising interest rates, we saw oil and silver do very well after interest rates bottomed. So let's do that. Let's do that chart here. Let's do US oil because I know that goes way back. In fact, let me do this. Let me do US 10-year. We'll do that as the main chart. We'll do that as a line chart. And then we'll do US oil as underneath it in a new pane. We'll do all. We'll do logarithmic on that. So there is oil. And then here's oil pulling back. Just like yields, oil has gone up with yields. It peaked, and oil is doing basically a gigantic cup and handle like silver is, something very similar. So we have a kind of cup and then a handle that's formed. We have another kind of cup and handle here too that is forming as well for oil. Yeah, oil. So what's going to move it? It's going to be interest rates, in my opinion. And oil is going to go up with interest rates, just like silver is going to go up with interest rates. So don't get too alarmed here. It's a very similar chart pattern with interest rates. And yeah, oil hasn't pulled up yet. So I think it will with silver and how correlated they are. Freight futures AM update, dry bulk down, Capesize 3%, Panamax down 1%, tankers are up, VLCC is up 2%, Suezmax is up 4%. We've got the last one here. 85% of new cars are financed with an average monthly payment of $745 a month. WTF, why the face are you guys doing out there? What the heck are you guys doing out there with this type of payment? That is crazy. That's a crazy high payment. And no, I wouldn't do that myself. But that's where I'm going to end it, guys. So give me a thumb up for the content. Subscribe to the channel. Subscribe to the website if you like. Specials at coupon code. I did release the midweek update, so check the website that's been released and where I share my opinions. So that's all I've got for today. We'll catch you next time, guys. See ya.